Imagine this, $2,000 stimulus checks hitting your bank account mid-2026. We have Bitcoin bleeding to 91,000, and we have global central banks pumping trillions. And inflation, well, it refuses to stop. Every headline today screams uncertainty, fear, and opportunity. Are you ready to navigate it? And what are some smart decisions that can be made? What's up, family? It's Coach Masi, and you're locked into the Daily Hodl. This is where we break down the biggest financial news, Bitcoin insights, and market trends so you can stay informed, disciplined, and ready for opportunity. Let's dive right in. Okay, breaking today. Reports confirm that President Donald Trump plans $2,000 stimulus payments for Americans earning under $100,000, expected to roll out by mid-2026. Now, last week in my comments, many of you pushed back when I called them stimmy checks or stimulus checks. Well, today, the media is using that exact term that the president is. So let's get into what really matters about it. In short term, well, households could see a welcome boost in cash. This money could help cover essentials like groceries, rent, utilities, or even discretionary spending. And that extra spending has the potential to give consumer confidence a temporary lift. If you look at the medium term, well, stronger consumer spending could create a mini boost in the markets. Retailers, service sectors, and even equities could see a short-term lift as optimism returns again. Asset owners might celebrate this immediate effect, like I will. And then you have the bigger picture. This is not a long-term solution. It's a band-aid. These payments are a temporary fix. They do not solve the underlying issues. We need policy. And structural inflation, rising household debt, stagnant wages, and cost of living are all still a problem. For markets, this could mean a short-term rally, of course, but it could also add to inflationary pressure that the Federal Reserve will be watching closely. While asset owners may benefit like you and me, for everyday Americans living paycheck to paycheck, the relief may be limited. So the takeaway, while stimmy checks or stimmy payments or stimulus payments can provide temporary relief, but they are not a cure for the deeper economic challenges. Households and investors alike need to be aware that the structural issues remain, even as the short-term boost hits the economy when it does. We also have Bitcoin continuing to sell off, falling to 91,000 today. We got Ethereum struggling, MicroStrategy going down, other treasury companies that are really feeling the pressure. So why the bleed? Well, we got forced liquidations from highly leveraged traders. We have negative sentiment in the market as panic spreads on the fear and greed scale. Macro uncertainty with global interest rate shifts and stimulus announcements. But here's the nuance. Some of the largest wallets are quietly accumulating, which historically signals a bottom formation phase. No guarantees, but we are seeing on-chain signals of whales buying during dips. The key question is, where is the bottom? Well, we have to look for extreme fear levels, which we have, trading volume spiking, and institutional activity. You see, history shows panic selling is often followed by the next accumulation phase, leading into bull markets, but it's better to be careful, slow down, and stick to your long-term investing plan. You see, markets are getting flooded with liquidity over the next 12 to 18 months, I believe. We even see in Japan, they mentioned a 20-year government bond yield hitting 2.75%. That's the highest ever, alongside a 110 billion stimulus package. We have China approving a 1.4 trillion stimulus. We have Canada restarting quantitative easing. You might think this is bullish, right? But here's the trap. Inflation hasn't cooled all the way. Stimulus is trying to force economic outcomes instead of fixing underlying policy problems. And poly market data, well, the odds of no rate cut in December now are at 53%. Traders are navigating a maze of stimulus, inflation, and uncertain interest rate policy. You see, Americans are feeling the financial squeeze like never before. Total household debt, well, it has skyrocketed to a record 18.6 trillion. Breaking that down, mortgages 13 trillion, auto loans almost 2 trillion, student loans almost 2 trillion, credit card debt 1.2 trillion. You see, over the last 10 years, total household debt has surged 60%, while credit card balances alone have jumped 50% since 2020. So what does this really mean for everyday families? Well, essentials are harder to afford. Like I said, groceries, rent, utilities, and gas, they can be rising depending on where you're living. Families are forced to make tough choices, often cutting back on basic needs just to stay afloat. And we have the holidays coming up. And we all know that savings are shrinking in real terms. Inflation erodes every dollar in the bank. Even disciplined savers feel the pinch. And emergency funds that are once offered security are now barely covering the few months of expenses, especially as the labor market cools. Disposable income is completely disappearing. High debt obligations and rising living costs leave little room for discretionary spending. Vacations, dining out, and entertainment become luxuries, not the norm. Stress and uncertainty are rising. You need to know that the mental and emotional toll of debt, combined with stagnant wages, affects families' confidence and ability to plan for the future. But here's the critical part. This isn't just about debt, it's about who benefits and who struggles. Liquidity is flooding the market soon, yes. Stimulus measures are in place, and asset owners are seeing unprecedented gains in stocks, real estate, and other investments for sure. Meanwhile, wage earners and households without investments are bearing the brunt of the economic pressure. This is classic K-shaped economy that I mentioned before. The top grows richer and more secure. The majority of Americans face rising costs, shrinking income, and mounting financial stress. You see, the lesson here is clear. Understanding this divide is key to navigating the economy. It's not just numbers, it's real people, real families, and real financial consequences. And I care about those people. On another note, Pulte is exploring what I talked about before, portable mortgages, letting homeowners take their low interest rates with them moving to a new home. So at first glance, this sounds like a game changer for homeowners. Instead of being stuck in a home just to keep a low mortgage rate, people can finally move freely. But see, here's why this could be a positive for the housing market overall. You see, empowering homeowners is important. It allows you to be a move up buyer instead of, or you can even downsize, really. You see, families who need more space or want to downsize can do so without giving up their favorable rate. I know I got 2.375%. So this could unlock hidden liquidity as homeowners feel confident making a move instead of holding on to a property out of fear of higher rates when they trade up or down. It's encouraging more transactions, I believe, in the future. And with portable mortgages, homeowners are incentivized to trade up or relocate to another state or somewhere else for work. You see, more transactions together can stimulate the housing market, benefit sellers, real estate agents, local economies, inspectors, everyone. See, that's important. Even the first time home buyers. Gives flexibility, right? It gets rid of the housing bottleneck in some ways. Moves inventory. Could be a buyer's and seller's market transitioning. So we'll see what happens. Maintaining affordability is important for existing homeowners. People can protect themselves from rising interest rates while still being able to move strategically. So this does add a layer of financial security, letting homeowners plan long term without fear of losing the rate advantage. Creating a more dynamic market is important. So I like portable mortgages because they could, make the market less rigid and more adaptable. You see, homeowners are less trapped by interest rate conditions, which can lead to more fluid housing supply, right? And better overall market health. Bottom line, I'm for portable mortgages because they're not just a perk for the current homeowners. Everyone benefits from them. Everybody in the industry, from housing to real estate agents to everybody. The implementation is important. It's a win-win for everybody, sellers, buyers, all the economy. And then we have Bitcoin at 91,000, bleeding. But history does teach us to watch for extreme fear as a buying opportunity. You see, global stimulus in the future and liquidity create more of temporary optimism. So it's worth watching, the household debt. It's worth watching the K-shaped economy dynamics and housing struggling and benefiting from different, maybe policy changes. Market participants should be disciplined, should be informed by watching this channel, and should be strategic, understanding cycles before making moves. Here's my question to you. Is Bitcoin forming a bottom at 91,000, or do we have more pain ahead? And how do you see stimulus and global liquidity impacting markets for the next few months to 1 year? Comment below. I'd love to see what your thoughts are. I know we call them dividends, but they're called stimulus checks overall. Don't forget to like. Don't forget to subscribe. Thank you for watching my channel. Thank you, family. That's your Daily Hodl. Stay sharp, stay disciplined, and as always, Lead.Pray.Hodl. I'll see you in the next one. God bless.